Mike DeSepoli, Heritage Financial Advisory. Welcome to Heritage Insider Weekly for Friday, September 6th, 2024. I hope you all having a great week. Tough week for the markets, shortened trading week, 4 days. We saw a couple down moves starting on Tuesday right out of the gate. Markets continued the selling through the remainder of the week. Continued today after the jobs report. Did not calm any fears of investors that the Fed may be behind in acting and changing monetary policy. Now, these fears are exactly that. Right now, they are just fears. Fears tend to get overblown in the marketplace as there's knee-jerk reactions, and then the dust will settle thereafter. Also, when you add into the mix that today is a Friday, it tends to create some increased volatility as hedge fund managers and investment managers alike are hesitant to put on additional long positions in front of a weekend. So when you look at why did the market react poorly today to the employment report, because we had a positive open, right? Markets saw the report, liked the report, were trading higher on it, and then reversed as soon as the market opened. You can see right here on the screen with the S&P started up here on the top left and finished down here. Why did that happen? The report itself was not a bad report. The issue that a lot of people are taking is with the downward revisions of previous months. So we had several, and this is normal for every jobs and labor release. They go give you the current month's data, and they'll give you any revisions up or down from the previous 3 months that they have, come to calculate, right? If they've maybe miscalculated some things or new data comes in, they'll make those adjustments. We've seen 2 months in a row now pretty significant downward revisions for the previous months. So what the narrative that this is building in the market, I'm not saying this is a valid narrative, but again, investors tend to have a shoot first, ask questions later mentality. So the narrative that's building, right, is if the Fed has held off on cutting rates, right, eventually, obviously in September here, they're going to cut rates. But if the Fed had held off for a number of months on cutting rates with their singular reason being that the labor market looks strong, what does it mean now if we're getting revisions going back a couple months to say maybe those reports were not so strong, maybe they were not as high, 180, 200,000 jobs, maybe they were 120 or 140, right? So still job growth, not a negative, but job growth well below trend. So that naturally today markets ran with the narrative that the Fed is behind the curve, meaning the market has moved, the economy is deteriorating. And again, this is not my view. This is just what the prevailing narrative is. I want to lay it out for you so you can fully understand how these types of moves can manifest in the market. But that's the narrative that took hold today. As we know with markets, very volatile, August, September, October. So while markets and participants always want to point to a particular reason why a market did something, sometimes markets are just shaking the tree to prepare for what comes next. We are not, we are used to September volatility, right? This is nothing new to us, no surprise. So let's take a look at the markets here. And again, right, where we are at in this current cycle, the markets, we talked about this last week. I was not expecting this week to be as negative as it was when we spoke about this, but we talked about the likelihood that the market, because it shot up out of accounting, was going to backtest the trend line, right? And that's exactly what you have here. Markets closed today. They parked the bus right on top of our trend line. So we'll see next week if the trend line holds, as it has many times in the past, and will the market move higher. This is not a bad spot to be, considering the fact that we've laid out some support and resistance points ahead of time. Okay, nobody likes a decline like the last 4 days, but nonetheless, here we are. We are in an ascending trend. Remember, an ascending trend. We are in a bull market unless or until something changes, okay? And little corrections or little pullbacks like we've had over the last couple months, we are getting used to these at this point, right, folks? We've seen this before. We know that during the declines, it gets very noisy. The news is talking about it. Media, sending out emails, newsletters, blasts, right? Everybody's talking about it. All the people that missed the entire rally are telling you how, see, I told you it was going to crash. And yet here we are, 4.5%, 5%, maybe 6% off of all-time highs. So this is not the time for panic. This is the time for market cycles to be allowed to run their course. And let us not forget, let's go back to last year in the summer, okay? Excuse me, when we were coming out of the summer. So here is your August, September, and October right here, okay? Here's your August, September, and October last year. And then we all know what happened next, okay? So the market went on to add nearly 35 or 40% off these lows. So I'm not saying that we should expect the same type of decline, but we will know what the clues to look for are, and we will know what to do with it if we get it. Right now, the market is really just working off some excess volatility, right? If you went to sleep on Tuesday, June 11th, and woke up today, market's gone nowhere, right? You probably didn't think you missed that much. Pretty uneventful market, but you'd be surprised to find out the volatility that we've had. So again, haven't said this in a while, volatility is like grapes. It comes in clusters. That's what we're seeing now. When we see the volatility index here, right, we had our huge spike on August 5th. We settled back down a little bit, and now you're getting another little bubbling of volatility here, right? So again, that's okay. Little aftershocks are to be expected. Obviously not looking for a repeat of what happened with that event on August 5th. And when you look at it, folks, right, every rally, let me just get this fixed here for a moment. Every rally needs a successful retest, right? So we made that low on August 5th. We came out of it. We're pulling back. What every technician is looking for now is the establishment of a higher low. So a higher low would be meaning that this little pullback here ends at a higher point than the previous one, right? So here was our initial low, right? We have the rally, we have the pullback. Anything up and around this area here, give or take, would be totally fine. See the market pull back, and then off it goes. And that would be the establishment of a higher low. We've seen that many times before when we look back over the previous year, right? Markets move up, they make a low, they move up, they make a higher low, they move up, okay? And we're looking for the same thing here. Make a low, move up, let's get that higher low, and let's keep going. When we look at fear and greed, investors are reacting as you'd expect. Pretty decent level of fear in the marketplace right now. So good reaction. Just a week ago, we were seeing 60, 65, 70 readings on the fear and greed index. Now we've snapped back in 4 short days. So again, markets, like a rubber band, when they get stretched to extremes, they will snap back. So again, right now, just seasonal weakness, seasonal volatility, a lot of uncertainties floating around right now. Is the Fed going to do a 25 basis point cut? Are they going to do a 50? If they do a 50, does it mean that they're too late to the party? On and on and on. This is what the pundits do. This is what they get paid to talk and discuss these things all day long. We're concerned with fundamentals and price action. And as of now, nothing has changed in our view. We continue to believe we go higher. I think they'll shake the tree here a little bit more in these next couple days and weeks, but we believe we will finish the year on or near the highs. 6,000's in our sights. It sounded a lot more silly when we were talking about 6,000 all the way back here at 4,800, but here we are now, even after a little pullback, 5,400. So we're getting there, folks. Hang in. Volatility is not a malfunction of the market. It's a feature of the market. Volatility creates opportunities. We know what to do with them well. So if you have any questions, reach out to us. Always here to talk to you about anything that matters with your money. Hope you have a great day and a great weekend. We'll see you back next week on Heritage Insider Weekly.